Okay, these are my dividend and passive income numbers, and we're going to be updating them in 3, 2, 1. And there you go. There the numbers are plugged in now. So far this month, we still have till the end of May. I'll probably be making 1 or 2 more deposits, but these are the updates. But this is not the reason you came to the video. You came to hear about 3 different stocks, and the 3 different stocks that we're going to be going over in this video in order is Draftkings, DKNG. We're going to be going over SRNT, which is Sorrento Therapeutics, and then one that has been very popular over the last week or two, which is VTIQ or VTIQ. So these 3 stocks have had huge run-ups in the last couple of weeks, and I want to be breaking down the pros and cons here. I got a list for all 3 of these stocks, the pros and cons to all 3 of them. Then I'm going to give my opinion on whether or not you should be buying these stocks, if they're good deals, and what my opinion on them is. And as usual, if you like watching my videos and you enjoy my content and you're interested in using M1 Finance, I have this link right here. And first of all, before we go any further, I would like to thank the 9 people. We are now up to 9 successful referrals. I've had a lot of issues trying to deposit money to my account with the recent shortage of hours due to the shutdown that I've experienced. But you guys that are using my referral link are helping me out a ton using this link. So if you're interested, use that down in the link down below in the description. We can each get $10, and I'll make sure to mention you in the video if you comment down below. And as usual, if you're interested in seeing an update on my portfolio specifically, we have had some very, very good performance over the last couple of days for the stock market and my stocks that I own in general. You can see right here. And I'll be saving that for the end of the video. So if you don't want to hear about these 3 overvalued, crazy, hyped up stocks, just fast forward to the end of the video and you can watch my portfolio update. But those of you that are here to hear about the 3 stocks that I put in the video, let's jump right into it. And the first one that we're going to be jumping into is DKNG, or Draftkings Incorporated. Now, I'm going to be going over the reason. I'm going to pull up an email here. I just wrote a quick little pros and cons list, and I'm going to be going over them one by one. So first of all, what Draftkings does, they're basically a mobile platform that has revolutionized online sports betting. Usually, if you wanted to bet on something like the Super Bowl, for example, which team is going to win, certain statistics, odds against different things, you would have a hedge against you where you'd be betting against the house, and you would usually be betting which team would win against a certain amount of odds. Well, this basically brings it to the average Joe to where you can sit on your cell phone and bet play by play. Now, the funny story is about Draftkings, something that I wanted to tell you guys that's a little bit funny. I actually was one of the first people to ever get signed up for the beta for Draftkings. That's right, I had my email and username and all of my personal information registered before Draftkings was even released. Believe it or not, I was actually with my youth group when I was at church, and we actually had a trip to go see a Texas Rangers game. I was walking down the aisles, and we were trying to find our seats, and then as we went to go to the concession stand, me and my friend Tucker were stopped by this guy, and he just randomly walks up to us with a clipboard and a pen. He said, "Hey, you guys, do y'all like sports?" And we were like, "Yeah, we love sports." He said, "Do any of y'all follow any kind of like fantasy basketball or football or do any kind of sports betting or anything like that?" And we were like, "Yeah, sure." And then he went over this new thing called Draftkings, and we ended up signing up for it, and we were one of the first people to actually give the test run for it before this was ever released. So this is a pretty interesting take because I know a whole lot about Draftkings and how it works. I don't use it anymore, but I did use it for probably a year, year and a half. So I do love the product as a consumer, but as an investment, there are many items that I love as a consumer but hate as an investment and vice versa. So with Draftkings, let's go ahead and start with the pros. The first one is here, huge revenue growth. The numbers for the revenue growth on Draftkings was high well before COVID-19. I believe right now the year-over-year growth for revenue is sitting about 30% year-over-year. It's huge. That's like the type of stock you usually see with something of like Shopify numbers. And you can see how Shopify has done over the last 5 years. It's been incredible. Imagine if you would have invested in Shopify 5 years ago. And even in the last year, they're still almost triple what they were 2 years ago, a year ago. So when we talk about Draftkings, is there going to be a similar situation with Draftkings? Are people going to get rid of their ESPN Plus, get rid of Las Vegas sports betting, and they're going to switch to this? Well, I would say this. I always talk about the fad is bad, but the trend is your friend. So the trend being everyone is obviously going more and more online. People are spending more and more time on their cell phones. And people that have sports betting don't really have any other competitors outside of Draftkings. Like I said, the only main competitor is in person with Las Vegas. That is not really a competitor to Draftkings where you can pull out your cell phone and bet play by play. It is live sports betting. It is literally, just to give you guys an idea that haven't used Draftkings before, basically, just to give you an example, It'll be like, let's say the end of the first quarter for an NBA game just ended, and they're on the break on the TV commercial. Your phone will pop up with an alert, and you'll bet a dollar amount or coins or whatever, and it'll say Russell Westbrook will score more than 7 points this quarter. And then you'll bet yes, he will score more than 7 points this quarter, or no, he will score less than 7 points this quarter. That's a basic understanding of what DraftKings does on a play-by-play basis. So I think it brings a lot more thrilling excitement to these games as you get to bet play by play, because it changes by the moment. Because if Russell Westbrook gets hurt in the first quarter, that bet would never come up to you. It adjusts accordingly. So this is a perfect example of what I'm talking about, where it's revolutionizing sports betting. The second point here pretty much reiterates with what I just said. The future growth potential is very high, as this is a very proprietary product and that no one else has it and it is very unique. And I love them as a consumer, and I think that this is a very wonderful service to use. So even if you are not interested in using them as an investment, if you like anything to do with sports, especially with sports gambling, betting, risk-taking, anything of the sorts, download this app. You're probably going to love it. But let's talk about the cons of this investment. The first off is the stock is almost up 300% from its lows. As you can see here, it was down to about $11, and then it shot up all the way up to the 30s. So we're talking about almost a 3 times in stock price. So let's say you want to invest the stock. Before we go anything into the financials, the future growth potential, anytime you're wanting to buy a stock, do you ever want to pay for a stock once it's 3 times its stock price in the matter of, what, about 2 months or so? About 2 months from the time it bottomed out? No. And then the second point I have here is momentum / overvalued. The reason that this stock is going up so high is strictly it's a momentum play. People are buying and selling and buying and buying and buying and selling, and it's just driving the price up higher and higher and higher, and the demand for the shares are so high that the share price just absolutely explodes. It's a momentum play. People are buying and selling out of this rapidly. People are not buying this to invest in it to hold for long term. People are buying it and selling it in minutes, in hours, or in a day. So just strictly on a valuation standpoint, this is so overvalued. The fact that this IPO'd around 10, 11 bucks and it's up to 30 now, guys, don't mess with it if you're looking for it as an investment. If you're wanting to invest in it, buy it at a cheaper price once it comes down back to reality. The third point here is, and this should be the most obvious if you're looking at a company that has recently went public, this company went public less than 6 months ago. So first off, what they have is what is called a lockup period for those that own shares in the company before the IPO. So if you've ever seen the show Shark Tank, for example, people buy a percentage of the company before it goes public, like angel investors and institutions and things like that. So basically, they give up a huge dollar amount and they might own 20% of the company. So when this company goes public, 20% of the shares that are available to the market, they now own. But the SEC has a regulation and a rule that says you must hold the shares 6 months after the IPO date before you can sell. So usually, with 90% of the time with any IPO, I don't care if it's a tech company, I don't care if it's an industrial company, whatever, anytime that a company goes IPO, usually exactly 6 months after the IPO date, it is 95% of the time in the red. Because those huge institutional investors, for example, let's say you're one of those guys off Shark Tank and you own 20% of this company, and you have your investment tripled, quadrupled in just the matter of 2, 3, 4 months, wouldn't you immediately want to cash out? You've had that money probably tied up for years or maybe even a decade. Wouldn't you want to finally get a huge return on your capital and put your money elsewhere? That is what is going to happen at the 6-month mark. It went public here late December, right around Christmas time. And so that means that this lockup period will end late June, so about a month from now. So that already is going to put some downward pressure on the stock, regardless of what DraftKings does as a business and as a company. So the fourth topic here I wanted to point out, this is an unprofitable company. So not only has this company shot up huge in stock price, but this company loses money. They're at a high growth stage where they are intentionally operating as a loss so they can gain more market share. Now, I'm not saying that a company cannot succeed from this. So one of the perfect examples is Amazon. Amazon operated at a loss for years. And I mean years. Amazon was a horrible company as far as profits go for so long. And look how that company's turned out. And there are other companies that are in the same situation in a time like where DraftKings is, like a Lyft, for example. Lyft is operating at a loss to gain more market share from Uber and its other competitors. That is not necessarily a bad thing, but in the short term, talking about profitability and valuations for companies, it's hard to put a high valuation on a company that literally has never made $1 worth of profit. So that is just something to keep here if you're looking on investing in this for the long term. At least probably wait for opportunity when profitability shows up, or at least try to get it at a better share price. And then the fifth point that I wanted to point out here, this is not something that is going to be tied in with DraftKings. I wanted to point this out because I wanted to compare this to SRNE. Those of you that are waiting for SRNE, I wanted to show the difference between an average momentum stock like DraftKings versus a short squeeze like Sorrento Therapeutics. This stock has 160 million shares in the float, and the volume is roughly 20 million shares a day traded. So that is a pretty high volume trade, but that is not something that is completely out of control. Like I said, I'll be getting into that in SRNE stock. But anyways, that pretty much wraps it up for DraftKings. If you're wanting to buy this company as an investment, please wait till it gets back down to stock price. At least wait till it gets under 20. I would probably wait till it gets in the teens or maybe even closer to $10 because this is going to come to a screeching halt eventually. And don't try to day trade this, guys. Don't try to buy any kind of options or any kind of risky trades that you're going to lose money on. Stay away from the stock. If you're wanting to invest in it, I think it is a great investment opportunity if you can pick it up at a great price. Preferably under 20, preferably in the teens. So stay away from it, guys, and that's my advice for you on that. And then the next stock we're going to be going over is SRNE. I'll be going over the pros, and I'll be going over the cons with this, just like I did with DraftKings. So if we go to the year chart here, this stock is up almost on the dot, 2/3 of where it was in share price exactly 1 year ago today. As you can see, though, today, the stock is down 21.69%. Over the past 5 years, it's been almost exactly cut in half. It had a huge run up, and it's pretty much just been in a gradual line down ever since. So we're going to be going over the pros with SRNE. It's been covered a lot in media lately, and here's the pros, and here's what everybody's getting excited about it for. It could be the solution to the cure of COVID-19. Everybody's trying to find that one company that is going to come up with a solution, the vaccine, the whatever, that is going to cure this COVID-19 illness. And if that happens, this company is going to benefit huge from it. Who knows if it'll happen? We will see. But it is definitely a possibility with this company with some of the recent news that they've came out with their therapeutics and such. And then the second part is, this is probably the number one reason if you were to buy it. I don't recommend it, but these two reasons right here. It could go up even more, in parentheses, short squeeze. So the reason I wanted to talk about a short squeeze here. A short squeeze is when you short a stock. When this company goes up to, let's say, $24, and I said, okay, I want to short this stock. I am borrowing those shares from my broker, and I make profit off of each dollar that that stock's dropped. So if I short it at $24, and then it goes all the way here to $1.90, and then I cash out, I have about $22 worth of profit, because that's what I'm selling it for off of what I shorted it at. So basically, those who short the stock are betting that it's going down. So what happens in a short squeeze, when a stock makes a huge movement up, those people that have all these shorts until right here on May 14th, those are those people that have those shorts and the stock starts exploding. The brokerage that they borrow those shares from, they have to pay that brokerage back. They either have to sell them at a higher price and then someone else buys them at a higher price, or they have to deposit funds to buy those shares at a higher price, 3 times the amount of what they would have just a couple days ago. So this is what a short squeeze is. Basically, I could go into a lot more depth in this of what causes short squeezes, how they work, but basically it's people manipulating the stock price. And when there's a short squeeze taking place, it makes stock prices of any company explode. I wanted to show you some quick examples. So let's look at Beyond Meat example. A perfect growth story, has a lot of growth potential. They IPO'd at right around $65, and then they went up to $234. Probably one of the greatest run-ups for short squeezes that I've ever seen, which they're doing pretty well today, 6%. Tilray being the marijuana company that releases recreational and medical marijuana in Canada and the US. They shot up to $214. They actually peaked at $300. It doesn't show it on this graph. So they were a $20 stock up to $200 and change. That is a massive increase. That is a 10 times in stock price. So in the same thing when I talk about SRNE, this is a perfect example of why it could go up even more. Now I'm not saying that you should buy it, but speculators at this point are willing to pay any price. They don't care if they're buying it at $4 a share. They don't care if they're buying it at $7 a share. They are so excited and so pumped up about the huge potential and growth of this company once its solution gets fixed for COVID-19 that they're pretty much willing to pay anything for it. That's why people were buying it where it was just at $2, $3, and they were still buying the shares massively at $6, $7 a share. So this company could go up a lot more, and we'll see its future growth potential there. But my God, let's start going through the cons of this one. This is a horrible company for these 3 reasons. The first reason is unprofitable / no fundamentals. If you're wanting to buy this company as an investment, if you think they're going to come up with a solution for COVID-19, you're wanting to hold them for 6 months, a year, 5 years, whatever, and collect all the profits and share price gains off this company, this is, financially speaking, a god-awful company. This company has horrible financials, they have tons of debt, they have very little revenue, and if they come up with the solution for COVID-19, great, I'm sure they'll obviously benefit a lot from that. But once that's said and done, and even if they do benefit a lot from it, this is not a company you want to invest in. This is strictly a speculation play. If you want to invest in that, there are great speculation plays out there that you can invest in. That's fine. Just know what you're investing in. This is not an investment. This is a gamble. This is going to the casino and rolling the dice and see if you can double, triple, quadruple your money, and you could lose it all. That's what could happen here with Sorrento Therapeutics. This is a company that if they don't come up with a solution for COVID-19, we're looking at bankruptcy probably one day in the future unless they come up with some big solution out there. But the fundamentals behind this company, it's none. It doesn't exist. It's not there. And then the second point I wanted to short out, these two last points right here tie in with each other. And I wanted to show you this, and this is why I put it with Draftkings. So with Draftkings, there was 100,060,000 shares in the float and roughly about 20 million volume per day, and that's pretty high. But let's look at Sorrento Therapeutics. So when we had the huge run up here a day or two ago when it just massively skyrocketed, the numbers of shares in the float was 120 million. So what the number of shares in the float means, that is the number of shares that you and I buy. When you go and you pull out your M1 Finance app or whatever brokerage you use and you click the buy button, that means there is 120 million shares available. If you were to buy the entire company, you would have to buy 120 million of these. But the volume is roughly 300 to 500 million a day. The last 2 days or so when we've had this huge spike up, that is what the volume has been the last day or two. 300 to 500 million shares a day. But wait a minute. We just said that there was 120 million. How is there 300 to 5 million? How is there triple, quadruple that amount? That means that the people that are buying and selling these shares are buying the shares, selling them 5 minutes later, buying them again half an hour later, selling them again an hour later. You're looking at people that are buying and selling the stock to increase the demand of the share price. You're looking at them buying and selling it 4, 5, 6, 7, 8 times in one day. Literally, I'm not exaggerating. That doesn't even count the shares that aren't bought. That doesn't count the people that are holding the shares long term, whatever. 120 million shares and it's been traded 500 million times. If that's not a red flag, I don't know what is. You're never going to see a company like Apple, for example, that has billions of shares trade all of its shares 4 times over in a day because people are not investing in that company. People are trading this company. People that buy Apple, most of the time, are investing in it. They're holding it months, years, decades, whatever. People that are buying this company are selling it 5 minutes later, 30 seconds later. This is not an investment. It's a gamble. So overall, just to wrap up with SRNE, it's a joke. Guys, don't touch it. Don't even think about it. Don't day trade it. Don't do options. Just forget about it. Forget that it exists. If you see any awesome news, amazing articles about it that's going to tell you how awesome it is, how it's going to revolutionize the world and COVID-19, ignore it, burn it, throw it in the trash, get rid of Sorrento Therapeutics. Don't touch it. Forget it out of your mind and invest in safe, stable dividend stocks. So the third company that we're going to be going over here is VTIQ. And VTIQ has had a whole lot of news media coverage over the last month or two. So if we look at VTIQ here and we pull up the 3-month chart, and even if we factor in the last 3 or 4 days being pretty heavy down days, we are still up 111.12% in VTIQ. And even if you factor in today's gains, it's going to be more than that because today it is up 19.5%, 19.56. That is huge gains. Those of you that are VTIQ shareholders, I'm sure you're sitting pretty right now and hopefully you're cashing in on those gains because these will be going away soon enough. But basically, we're going to be going over the same as the other two. We're going to be going over the pros and we're going to be going over the cons for VTIQ. Now, the first one that I wrote down here is that it is the possible competitor to Tesla, maybe the only competitor. Now, first off, there are tons of other car companies out there, and let's see how they're doing. Oh, what about General Motors? They're a pretty good company. Oh, they're down horribly. They have pretty much been trading flat for years, and now they've dropped because of COVID-19. Okay, well, what about like Ford? Ford's a huge motor company. They're one of the largest and oldest in the world. Okay, they're down 65% in the last 5 years. They're a $15 stock, and now they're trading at $5. They just cut their dividend to try to survive, and they almost went bankrupt during the Great Recession. Not very good. But when we look at Tesla, when we look at a company like Tesla, or even in a recession scenario, that's awesome. They've went up. So the peak was in February 19. They were about to hit an all-time high. I think if you actually look at the candlesticks, I believe this day was actually higher. But they closed at $917 a share on February 19th. And then we had a huge flow down of March of 2020. And they bottomed out at still $361 a share. And today they are over $815 a share. And they're even in the green again today. This shows you that a company that is well run, investing in the future, and has huge high growth potential, people don't care what price they're buying at. They're trying to get in the stock because they know it's the future. So I want to take a company like, for example, one of the companies that I own. I'm going to show you two of them. The first one is Microsoft. Microsoft, it is nearly at its all-time high. It is just a couple dollars off, so 188, about $3 off from its all-time high. Even with this recession, with all the worries that could happen with Microsoft, all these institutions, these hedge funds, they can't stay away from it. It's growing dividend, it's growing revenues, it's growing share buybacks. It is one of the most safest, most stable investments in the world. In the last 5 years, it's up 282%, and it's a perfect example like another company I own, for example. Let's look at Apple. Apple has had huge share prices over the last 5 years, almost as good as Microsoft, 144%. It is almost at its all-time high as well. It's 317. Its peak was about 327. $10. $10 for a $300 company. That's nothing. One last one that I want to point out here is that NIO stock. NIO is another competitor to Tesla that a lot of people rumored about over the last couple of years. They are down 45.3% over the last 5 years. This has been a horrible investment, very unprofitable, not a company that I would recommend one bit. But going back to VTIQ here, if we pull up the 3-month chart for VTIQ in this huge run-up, and we see that it is possibly the only competitor to Tesla. I'll be debating that in just a moment, but let's say that it is. Let's say that this company, this Nikola Tesla, can give it a competitive advantage over Tesla, and it can gain a lot of the market share compared to them and the other electric vehicle companies. This could be huge. This company, right now it's at $25, $26 a share. We're not talking about 25, we're not talking about 30, we're talking about hundreds of dollars a share. We're talking about an ROI potential that is massive. Those you I just showed you with Tesla, you saw the huge share price gains in the hype behind Tesla. So many people believe in it. I believe in it as well. Look at these share price gains, and I'm sure in the next 5 years, 1,000 is going to be a joke. This company's not going to 1,000. This company's going to 5, and maybe even one day, way out in the future, 10,000. So the same thing with TVIQ here. The huge growth opportunity, it's massive. That said, as high as it is, they do have a lot of obstacles to overcome. The fad is bad, but the trend is your friend. So fads, basically what fads are, is when people get all hyped up about one thing for one short amount of time. If people, for example, everybody likes Coca-Cola. If Coca-Cola came out with a spin-off, if they came out with a great Coca-Cola, and everybody drank it for 3 months, everybody and their dog was drinking it, buying the hell out of it for 3 months, and then everybody got tired of it and stopped doing it, that is what a fad is. It's usually like kind of like memes, where memes explode for a couple months or a couple weeks, and then they die and no one ever sees them again. They become dead memes. That's a fad. A trend is a long-term growth story. In the same way that people trend towards electric vehicles, people are going to get more and more and more electric vehicles over the next 5, 10, 15, 20 years. So that is the trend is your friend benefit for having VTIQ in your portfolio. So the third point that I wanted to point out here is the extremely long growth potential, which basically goes with what I just said. The trend is your friend. The huge growth potential. If they could get some of the market share that Tesla has, it's game over. This company is going huge. And the huge amount of investor interest is another thing that I wanted to point out. In the same way that Tesla, where people were bearish on it, it was one of the most heavily shorted stocks in the entire market. Everybody shorted it, and now everybody wants a piece of it. Nobody's doubting it. Everybody wants to invest in it at any price. Gimme some more. The same thing goes with VTIQ and the opportunity here. If they get to that point where they're like a Tesla, the same thing's going to happen. They're going to be buying it relentlessly. These hedge funds, when they get excited about a stock, they don't move the stock 10 or 20%. They double, triple, quadruple. As you can see, the stock has went from $13 up to 30 plus. That said, now that we've got over all of the bullish sides of this stock, let's get to the bearish sides. Let's snap back to reality And let's talk about their microscopic market share. I was talking about them potentially taking over the market share for Tesla and the opportunities they have there. Right now, they're absolute nothing burger, as Mr. Wonderful off of Shark Tank would say. Absolute nothing burger. They have little to no market share. It is so small that it is microscopic. It's not even worth mentioning. They have a lot of growth ahead of them if they want to get to a dominant position in the market. They have so much marketing, so much amazing development for companies and vehicles that they have to do. So for me, investing in this company today, know that you have that huge return on investment opportunity, but know that you also have the huge risk of your investment. So that is something to think about. The next point is the high barrier to entry. It is not cheap to make these electric vehicles. So for example, I don't know what the exact price was. The first Tesla that ever came out that was an electric vehicle, it was something ridiculous, like $50,000 or $100,000. Talking about like a decade ago when they first started developing these vehicles. So the high barrier to entry is there's so many other competitors and they have so many other high monopolies, is that it's so hard to get market share because there's so many competitors that have so many amazing, absolutely incredible inventions and investments and innovations along these electric vehicles. So for VTIQ, the new kid on the block trying to come in here and compete with those big dogs with hardly any capital and hardly any experience or any kind of market share, not saying it can't be done, but it's a long shot. I think we might see another NIO opportunity here. The third one is, and that pretty much goes along with the high barrier to entry, no electric car company other than Tesla has survived in the US. So many other huge car companies have tried to make tons of different funding and investments and raising capital to try to create the new best gas or electric vehicle to try to take over the market. It's never worked. Elon is the one exception. The guy's Elon Musk. Before Tesla, everybody worshipped Elon Musk. He is the one exception. I wish I could be as cool as the guy, but I'm not. I never will be. Neither will you. Tesla is the 1 in a million chance where you get an electric car company that comes from nothing to one of the most dominant players in the market. I don't think VTIQ is going to be something that can do that, and I don't think they have an Elon Musk. That's the main reason here. Even if their products were absolutely amazing, if they blew Tesla out of the water, blew Ford, General Motors, VTIQ has such a long story ahead of them that they don't have an Elon Musk to carry them through that till they get to that point. So that is a huge risk there. The third one is already buying at a premium of 200 to 250% higher than you would have just 3 months ago. If you're wanting to invest in this company now, a lot of the growth is already priced in. Why would you buy it at $26 a share when you could have bought it at 13? You could have speculated at 13, bought it, hoped for a great return of one day. But now that it's already priced up 26, regardless if you think this company is going up or not, buying at these prices, it's a bit ridiculous. And then last but not least, it is much like NIO, and I think that they're going to have a whole lot of hype about them for a couple months, and then they're just going to die out and become absolutely nothing. And you can see, as I showed earlier, the 5-year chart for NIO. It looks really ugly. So overall, just to give my overall opinion on VTIQ, should you buy it? Should you trade it? Should you do anything with it? Like I say, with any of the stocks I recommend, it doesn't matter if we're talking about safe, stable companies like Coca-Cola. It doesn't matter if we're talking about huge run-ups like Draftkings, SRNE, or VTIQ. Don't buy these companies on speculation. Don't trade them. Don't day trade them, options, anything like that. If you want to get involved with these stocks, if I had to pick one out of the three, and I wouldn't really want to invest in any of them, but if I have to pick one, it is by far and away going to be Draftkings. Draftkings has a huge long-term opportunity here, and I think as an investment, I wouldn't shy away from it. If they paid a decent dividend and they were more established, I wouldn't be against it. Maybe one day in the future, who knows. But stay away from these three companies. Don't invest in them. Even the pros for a lot of these companies are not really pros. They're more just kind of stories behind them. And these are not companies that you want to invest in. Invest in stable, safe dividend companies. So that way you can see your annual dividend income, your monthly dividend income, and your portfolio increase every single month like I am right here. And now that we went over these three stocks, if you made it all the way to the end, I'm just going to give you a very, very quick, brief update on my portfolio. So first off in the portfolio, we're now at a new high. We did make a new deposit. We did just buy 24 stocks out of my 31 that I own. You can look over them here. I'm just going to scroll through. I believe the largest purchase was Realty Income at about $10. And then if we exit out here and we go to my portfolio value, as of today, right now, my portfolio value is about $2,112. So that is a new high as we deposit more and more. We are now up to $219.05 worth of gains, or about 13.28% return, $210 worth of market gain, and $8.90 worth of earned dividends. And the biggest winners in the portfolio, man, we have some stocks here that are getting pretty ridiculously high on how up we are on them. Whirlpool, let me tell you, The fact that we're up 49.29, we're up almost 50% in this company. And what did we start? April 3rd, I believe. Just since April 3rd, so less than 2 months, and we're up 49%. There's so many of these companies that we're up double digits on. It's actually kind of ridiculous. Here, let's go ahead and count. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 of the 31 stocks. So over half of my portfolio, I'm now up double digits. And we're about to have our first 50+% gainer in the portfolio if we can get a good green day for Whirlpool. And the biggest losers in the portfolio, my brand new position, Starbucks, we were down 6 pennies on. And then we were down on another stock called Procter & Gamble. You all know that company. I've talked about it many times. So we are up on 29 of the 31 stocks that I own. These companies I love. I don't plan on selling them. And I did just sell out Wells Fargo. Those of you that didn't see my last video, make sure to go and watch it. And anyways, guys, if you made it to the end of the video, if you like watching my content, as I always mention, use this link. You 9 guys that have used it, I love y'all. I appreciate y'all. I'll look forward in the next couple of weeks to be getting y'all's referral money. And let me know down in the comment section. Send me a screenshot if you're interested in using my portfolio to invest in. If you're interested in using my link, there you go. There it is. And also the link to my portfolio is in the link of all of my videos. And this is the link right here. You can copy that and paste it into your web browser. But thank you guys so much for watching. Let me know down in the comment section what you thought about this video. This is a very out of the ordinary video. We usually cover very safe, stable investments, but I wanted to cover a little bit high interest, hyped up, incredible, crazy story stocks. But it was a lot of fun. I really enjoyed this. This is one of my favorite videos I've recorded in a while. But comment down below in that section what you think about these stocks, if you're going to buy them, if you're going to sell them, invest in them, whatever. Let me know down in the comment section below, and I'll see you guys next time.